What's going on, guys? Bryant here. Today is Sunday, March 20th, 2022, and this video is a little bit of a follow-up from last week Sunday's video that I recorded, which was a little bit of a reflection from the week prior, as well as expectations for the upcoming week as we were leading into the quarterly OPEX, which is what we just had this week right here. Friday was the quarterly OPEX. Now, there was a lot of gems in that previous video. It was recorded for the Quant Trading App members. If you're watching this on YouTube, I'll probably be making that video public for anyone to view. And then this video will probably be available to everyone in the public as also. Now, the Quant Trading App members, you guys know what to look for regarding the options premium and things like that. So starting right into that, that's the first subject matter I want to cover. You guys at this point should have seen this now covered. For anyone new or anyone needing a refresher, there's significant importance around these days as was covered in the video from last week. Now, why this is so important, these monthly OPEXs as well as the quarterly OPEXs, is because there's the most amount of money in those expirations. I showed you guys on the chart right here. This was just a rough or loose pointing at whenever the market has some sort of a huge reversal. And then in that video, I mentioned we had a little bit of bullish divergence in the RSI, but this was by no means a reason to take a trade. It was just something to be aware of. We had bullish divergence. I showed you guys in the RSI as well as the QQQ, as well. Coming into this week, we should have just been looking for reasons to be long. It didn't really matter what was going on with the macro events regarding Russia and Ukraine, regarding the Feds raising interest rates, regarding any type of news, because coming into OPEX, the options market has a huge, significant influence on the equities market, and you guys have been able to see this time and time again. So by next OPEX, I would love for all of us to be a lot more prepared, a lot more conviction behind holding some of our long trades, because even though some of you guys took the Apple trade with me from the swing on Monday into Wednesday, we missed out on a couple more days of a lot more gains, and there was a lot more opportunity aside from just Apple. And I also swung Facebook, but Facebook was more of a smaller trade. There's going to be a little bit more for us to be able to piece these type of ingredients together, if you will, or we're starting to understand or see the recipe using quantifiable information or using data that's not just based on discretion or saying, oh, there's a trend line here, the market's going to come down to the trend line and then it's going to bounce at 400 and go back up. We can actually build out a trade idea saying that no, we're coming into a quarterly OPEX, the options premium is significantly in balance, max pain is above 2 sigma. We can use more concrete information based on just the options market and build some large swing trades. So I'm hoping, if not the next two OPEXs, June is going to be the next really, really large one. And I hope that the market is significantly imbalanced going into June, because it should be a really huge win for us. My expectation going into the next quarterly OPEX is actually very mild, because the market is very balanced right now. And we'll take a look at that in a second. What I mean by that, again, for anyone that's new watching this video, with the market being balanced, the expectations regarding it going in any solid direction is no more strong anymore as it was once it was down here, because once we were in this zone, the area in which the market wanted to close was somewhere in this vicinity, which is what it ended up doing. The same thing when the market was all the way up here, the market wanted to be in this zone, which is where it ended up going. Once it went past it, it came back to it after OPEX. If we jump over to the Quant Trading App website, and let's actually go to the SPY. I'm going to keep this focus on just the SPY for now. And let's go to the general overview and look at the options chain for the SPY right here. There was actually a shorter way to get to it. I could have just clicked the options icon next to the SPY. But anyway, this is our options chain. Let me just make this dark mode for a second here. And what we're looking at is the entire premium for the SPY. You guys can see that at this point, this is no longer insanely imbalanced. And at about a week ago, this was over 130 million, if I remember correctly. And on the call side, there was probably 30 million in calls. So there was $100 million in premium imbalance in the SPY going into a quarterly options expiration. That's what OPEX is. If I keep saying OPEX, this is what I'm referring to. EX, right? So EX right there. coming into OPEX, you want to be aware of the imbalances here, and not individual tickers. It's mostly about the indexes and the ETF or the market as a whole. As we scroll down here now, we look at the entire options chain for the call side, and it would be the same for the put side. It's the same premium, it's just flipped down here. But if we're just focusing on the calls and we come down here, we can see going into the next end of the quarter here, options right here. So March 31st is the quarterly options for the SPY. This is when they expire. Pretty balanced. There's nothing really of its significance here. Look at how small the money is for these expirations. These are the Monday and Wednesday expirations. This is for this upcoming Friday. This is not a lot of money, guys. So if we were to click this right here, and again, this is the Quant Trading App site. Again, if you're watching this on YouTube and you're not a premium member here, but as we scroll down, we can see that the max pain is 435. And right now the SPY is closing at, it closed on Friday at 444.52. So this is about almost 10 points down. We can't look at this and say like, oh, the market has to drop because max pain is here. No, when we take it into consideration that this is how much money we're dealing with combined, we're talking about $2 million. That's nothing in comparison to what we were seeing. So in the video over the weekend, I'll pull up these screenshots again, assuming some of you guys either didn't view that video. Actually, let's close this out here, and then I'll pull all three like this. So if this is completely new to you, this was January 7th here to start the year, just to show you guys what I mean by an imbalance. This was going into the January expiration, so January monthly OPEX. This is the type of premium imbalance in which we were seeing. This was already a couple days after the market started pulling back. This number was actually a much wider. I believe this is over 25 million at this point. But more importantly, as we look out to the February OPEX, you guys see that things were pretty balanced, right? 5 million essentially on each side. Now, as we jump forward, so again, this screenshot was taken on January 7th. As we jump forward now, on January 24th, the market had sold off insanely amount, and you guys look at the imbalance. So this is how much money was in puts for the entire options chain for the SPY. This is how much premium was in calls. Now, as we look down here for the next expiration, so we're talking about January 24th. This now was the February 18th expiration, and look at the imbalance. So what do you think the market did on January 24th? It bounced, and it ended up balancing itself out by the time we got around to this expiration. Now, as we jump forward in time again, this is now that day, February 24th. So as I jump back in time, this screenshot here was January 24th, and now as we jump forward in time, this is now February 24th. Look at what ended up happening. The market sold off, so it bounced and then it sold off again, and look at this type of imbalance, which was leading right into this Friday expiration. So this screenshot was taken essentially a month ago when the market was insanely imbalanced. In terms of the options market was imbalanced. Now, as I minimize that, we come back to the chart. Take note of those days. January 24th, February 24th, the market bounced. The options essentially balanced itself out. All of these puts ended up expiring worthless, and there was a ton of open interest down here. Market bounced. All those puts are destroyed. Market sells off again. The market is in balance. Everyone's buying puts down here. For what reason? I have no idea. The market bounces. All of these puts are destroyed. Has nothing to do, again, with what's going on a larger, macro geopolitical events. None of that stuff is what's necessarily going to move the markets currently going into OPEX. Now, I myself neglected the opportunity here. I didn't think the bounce was going to come this fast. I thought it was going to bleed into next week. So I took profits here, and obviously it didn't feel good seeing this much more price action going forward as I started to scale into my short position by getting some put calendar spreads, targeting some sort of a pullback for next week. Now, take that as you will. I mentioned put calendar spreads. You guys know I love grabbing put calendar spreads as opposed to just buying naked puts, because I'm not looking to time the top perfectly. It allows me to be in a negative delta position, as well as have a positive theta position, as well as a positive vega position, which means if the market is bullish, I can maybe scalp some 0-day calls if I wanted. But I know for the next week or two, I'm going to be expecting some sort of a consolidation or some sort of a pullback. So I'm going to use a strategy that benefits from a consolidation or a pullback. You need to have your playbook, or you need to know what type of strategies to adjust based on what you're expecting. Now, the reason I'm not expecting much volatility or as much as it was before is because, again, the options market is essentially not expecting much big moves right here. So we come right here, the premiums are in balance for the end of the quarter. The premiums are in balance for the April OPEX, monthly OPEX. As we scroll down here, the next big imbalance we can find on this chain right here, if we jump down to June, this is where there's a lot more money. So there's $20 million in June, but this is not really that significant compared to what we've been seeing. Now, if the market was to go insanely outside of one of these directions, now we can check the max pains for these, particular our expirations, but to keep this video short, we're not going to go into every single expiration. But you guys, if you didn't know, you can just click this, and that's how you can get the breakdown of that expiration. So the one we want to take a look at is, say, for example, this upcoming week. I just click that, and that's how I can actually see where's the highest open interest and the highest premium. So again, here's our max pain level. Here's a little bit of the breakdown for the premiums for that expiration, as well as right now the highest open interest call is the 435, which is in the money. This is not a lot of premium though, relative to the grand scheme of things. And then on this side, we can see all the highest open interest puts are out the money because the market bounced. Now we can see that the highest open interest calls are the ones that are in the money, which means the market kind of went a little bit too far past where it was supposed to go. However, does that mean the market is going to pull back this week? I don't have as much conviction. Again, why? Because there's not that much money here. This is not really enough. This isn't really going to move the needle that much. Just because the market went past 440, it doesn't have to pull back to 440 just because it's at 444 or drop all the way back to 435. This is not that much money. Keep that in mind when you guys are looking at this, especially if you're new to looking at, open interest and basing your decisions based on what the option sellers are selling, what the market makers are doing. You have to be able to decipher and discern that not every single max pain is the same. Not every single OPEX is the same. It's about where's the large amounts of money. Quarterly options expirations are always going to have the most because there's only 4 of them throughout the year. So the next one, again, is not until June. And knowing this, we know what the max pains level will be for June. It means if the SPY is anywhere way past those levels, we can expect some sort of a reversion to that. And how, if we were to jump to the intraday chart, it was a little bit crazy to actually see it. I'm not going to lie. This is my first time actually seeing the max pain level way past the the Quant Trading App 2 Sigma level, and most of us I know in chat, we were actually in disbelief at the start of the week because we have these levels before the week actually starts, and to be able to see the market go towards that, it's almost unbelievable. The same thing with the Qs. Again, early in the week, we're aware of these, and there's a ton of tickers. If this time towards the end of this video, I'll just go and just cycle through a few of them. But to see the market going exactly to max pain, again, it makes sense. There's hundreds of millions of dollars across the board collectively for these max pains for all of these tickers. Now, how do we be a little bit more prepared for this the next time? That's where I'm always repeating the VIX, the VIX, the VIX, the VIX, the VIX. Get this, get an extra monitor, get an extra screen if you have to keep the VIX up next to the SPY. The divergence in the VIX is very important. Last week, if we jump back over to Quant Trading App and let's go to the charts tab. Let's see if I actually have this open here. Nope, did not have it open. And let's make this full screen. Let's jump. If you guys didn't catch this yet, the max pain now is actually on the charts panel for the site. But let's jump to last week here. And as we look at the QTA, so QTA is Quant Trading App, we're looking at the QTA levels. And full disclosure for anyone watching this, it's not a Quant Trading App. I'm the lead developer on this algorithm, so I'm just letting you guys know that right off the back here. Full disclosure. But as we look last week, Tuesday, here's our 2 Sigma level. Market struggled to go lower below it as it should. But more importantly, something that I mentioned in the video that I also want to point out right here, if we look at the trade recaps, guys, save these 2 screenshots, print it out if you have to. What do you want to look for the next time? Because every time the SPY comes down to 2 sigma, it's going to look scary. So I made this a little bit larger for you guys. This is the SPY below 2 sigma. It pops, hits VWAP, it comes back and it goes lower. It pops again, it comes back and it goes lower. This right here is a lower low, right? Then you want to take a look at, is there some sort of a sign to maybe get long? Your next step should be, what's the VIX doing? If the SPY goes to 2 sigma, bounces, breaks 2 sigma again, bounces and goes back below 2 sigma. It doesn't have to be 3 times. You just need to see 2 times it goes back below 2 sigma. And you look at the VIX, and the VIX goes higher and then drops and then goes back up, and it doesn't make it back up to 2 sigma resistance. That right there is divergence. That's your sign right there. So again, every time the SPY comes down to 2 sigma, there's probably going to be some sort of an entry or some reason for you to be long. A golden thing to look for will be the divergence between the VIX. The VIX is something that's very important, guys, because again, it's not like it's based on a MACD or some sort of stochastics or some sort of other, you know, indicator, one of the many thousands of ones out there. The VIX is calculated by SIBO, which is the Chicago Board of Options Exchange, and this is something that's used across the globe for measuring volatility for the S&P 500 or the SPX, and this is a proxy for measuring volatility for the entire market. And how is the VIX calculated? It's calculated straight from the horse's mouth, so straight from SIBO. It's based on the 30-day expected volatility for the US stock market. Volatility increases when there's fear and uncertainty in the market, and that's why it's sometimes called or referred to as the fear index, or the measure of fair volatility in the market. You guys can actually click here and see how was the VIX during the 2020 COVID-19 crisis. When did the VIX hit this? You can not that you need to necessarily play around with this. It's just to understand what's going on here. Now, as we scroll down, the VIX has an inverse relationship with the SPY. I'm going to do a dedicated video on this, but I just want to introduce this to you. It's a mean reverting instrument, which means as it goes up, it's going to want to come back to its mean. So if this is its mean here and it's popping up, it's going to want to come back to here. If it goes all the way down here, it's going to want to come back to here. If it goes all the way up, it's going to want to come back to here. It's always trying to revert to its mean. Again, this is straight from, if you're trading options, it's all coming from SIBO. Why not get a little bit more acquainted with the tools that they're offering? Now, as we look at the chart, we can see there was a massive divergence between the VIX right here as it collapsed. And I keep repeating this within Quant Trading App. It's what I'm spending more and more time trying to get you guys to understand, and how can you spot or be aware of huge trades that are coming up. If we look at this head traders panel here, as I'm mentioning this types of stuff, if the VIX breaks down below 28 this week, and the selling keeps selling off, all the overhead supply on the SPY won't matter that much. This is what I had posted coming into this midway through the week here. So going into the FOMC announcement, I was trying to let you guys know that it doesn't matter about technical analysis. It doesn't matter about supply zones. It didn't matter about the 2 sigma level. It was all based on what the VIX was going to do this week, or largely based on what the VIX was going to do this week, because of the relation that VIX has with all options. Now, puts are generally more expensive than calls. And if you trade options, puts means you think your underlying is going to go down, and you buy calls if you think the underlying is going to go up. Investors are willing to pay more money for puts because they want insurance on their investments. Option sellers are aware of that, so they're able to sell a product that people are willing to pay a higher premium for. So it's almost exciting as an option seller to be selling puts as the VIX goes higher, because it means you're getting more money for selling the same thing. You can sell an option that's expiring on the SPY maybe 30 points away. If the SPY is trading at 430, it means you can sell a 400 put, which is 30 points away, that expires in 7 days till expiration, which is insane. You can probably sell this put for maybe $2 or something like that with 7 days till expiration. This is only possible when the VIX is really high, which means you have 100,000 of that strike price being sold, over 100,000 open interest, 150,000 open interest, because this is essentially 100,000 times $2. That's how much money money is being collected. If you had the margin or the capabilities like a market maker, you can sell 10,000 of these puts. You can write these contracts, and there's a lot of other option sellers that are aware of this that are going to sell this strike price, because normally this put might only be going for maybe 60 cents. So during a normal market, it might be going for 60 cents. And by normal market, it could mean right now if the VIX is below 25 or below 20. But because the VIX is so high, you're able to sell this put for a ridiculous inflated premium, knowing that statistically the SPY is not going to go, below the 400 or close below 400 by that expiration. Now, what happens when the VIX starts coming down is that the value of this option starts losing value just because of time is passing by, and because of as the implied volatility comes down, so as IV comes down, so does the delta on these puts. So in this case, we're talking about the 400 strike price. Again, a more eloquent video will be explained about this, but I feel obligated to explain this as I proceed in this video, because I'm constantly repeating this until I feel enough of you guys really understand this. I'm going to continue explaining it. This right here, as I'm referring to, is called Vanna, and there's another concept which is called charm. As time is passing by, deltas are also decreasing on options. Now, every time a market maker sells a particular put, they also are shorting stock. However, as the delta starts decreasing for the put that they sell, they start back buying the stock, because they're always trying to maintain a delta neutral position and always trying to have not much risk to delta and gamma. That will be explained again more eloquently in another video, but I'm just trying to brush upon that subject matter to make that aware why the VIX is so important and why this divergence is so important. It's not, oh, the MACD is crossing over, or oh, the stochastics is crossing over, or oh, this EMA is crossing over that EMA. A lot of other technical indicators that beginner traders are using or buying all these books on and trying to learn. There's not enough people reading what's actually going on in the options market and how the options market is driving price. So as we look for massive divergence, I have this screenshot, or this charts up here, and this is showing essentially the same thing. Here was last week as the SPY sold off to 2 Sigma, and 2 Sigma is something that's proprietary. The 2 Sigma level in which I'm referring to is the proprietary 2 Sigma for Quant Trading App, and this right here is the SPY going lower and lower at 2 Sigma. So this was at 10 a.m. on 3/8, and now we're looking at, here's 10 a.m. on 3/8. We can see that the VIX was at pretty much 37.5. The SPY was at 416. Then the next time the SPY comes down to 416, the VIX had already dropped. Here's the same time frame right here, so at 2:30, and it doesn't really matter about the exact time. It's just, it could have been anywhere in here. I'm just showing you guys that these two levels are exactly the same dates and time. As I also move my mouse around, you can see that the crosshairs are mirrored. This right here is a collapse of, let's see what percent. So a collapse in the VIX of 10%. So from here to here, VIX is down 10%, whereas the SPY is pretty much balanced. That's showing in the 30 days till expiration, all of the puts in the SPX, as we just looked at on SIBO site, the next 30 days, so 30 DTA, 30 DTE, all the options for the SPX, there was a massive change right here. The expectation for the implied volatility dropped 10%, even though the SPY was exactly at the same place. You can interpret this as you will. You can say, one person might say the market was no longer afraid anymore of price selling. It could be large institutions when we say the market. Overall, collectively, people, all market participants, were no longer as fearful of the market going down. You see this type of thing, it means the lower the market goes, if the VIX is not going higher, you have golden opportunities to be buying. And that's something I mentioned in the video from last week Sunday. I said a golden opportunity is about to unfold before us, before it happened. Now, did I nail this opportunity? No, I'm by no means happy with my trading this week because I did not capitalize on this move, even though I was aware of what was likely to happen. I was hoping that the market went a little bit lower because I wanted to get cheap out the money calls, expecting us to go significantly lower. The fact that we got stuck a little bit here made me, I guess that's where the human came in. I was like, I hope we go lower to catch a bunch of people buying more puts because I wanted to sell some puts. bull put spreads, as well as buy some cheap out the money naked calls. Now, after seeing this with my own eyes, this type of move with the combination of all the tools that we have available to us in Quant Trading App and being able to decipher and discern this type of information means the next time I need to be prepared to take on a much bigger trade, and means if my normal weekly risk is $1,000 on a week like this, my risk needs to be closer to $4,000 to $5,000 because of the opportunity here. For every $1,000 risk on this week, the return was about $5,000 to $10,000 made. We had calls in things like Amazon going from $3 to $80 in a few days here. Like the opportunity across tech stocks was outsized, and I love being able to catch these outsized moves because during choppy seasons like this, I'm a little bit more running non-directional spreads, or I'm a little bit more passive in terms of my directional biases as I'm going into the next monthly expiration. So I'm showing you guys, anybody watching this, so you can understand how I'm going to make my adjustments. I'm already in and at the money SPX trade. I'll pull this up for you, the butterfly in which I opened. Now it's no longer at the money because I opened it on Friday, but I'm targeting by the quarterly expiration here as we pull this up, just so you guys can see my range in which I'm targeting over the next couple weeks. Collected over about $6,000 in credits per lot, but as we can see right here, this is essentially my range. I don't really think the market is going to do much outside this range, and obviously I'll make adjustments as it goes, past certain levels. But this is a good trade, and I'm looking to collect 10%, run another one, collect another 10% over the next couple of days. I'm going to be opening up at the money calendars tomorrow just to bring a little bit of positive vega back into my portfolio here, my options portfolio. But as we are looking at this, I'm also going to be aware of there's a little bit of insanity that's in the market right now, and have full expectations. A lot of technical analysis are saying, oh, this is the 200-day moving average. We broke the 50-day moving average. There's probably a good reason to start getting short right here. And because the market went up so high means it's got to pull back. And I don't like approaching or thinking about things that way because it's too speculative. And just because the market just made this big move does not mean the market has to come back down. And if it's more likely to consolidate for a while within a range, which means if it broke out from the range, it's probably going to have a fake out, come back into the range. The same way if it breaks out, it's probably going to come back into the range. So I'm looking to see that range be established and then size up in some of the non-directional trades. And it means if you guys know, I like to look for trades in which I can hold for 2 days, possibly 3 days, even if I'm swing trading. It means right now, this is a time where you probably won't hear me saying much of that. I'll say this is the instance in which you can take profits quickly because we're more than likely going to enter some sort of period like this, or we're probably going to enter some sort of period like this. And I don't mean necessarily direction. I just mean the change from this open to this open over these amount of days. This is a couple weeks. The market didn't really change much. The same thing from here to here over these couple weeks here, the market really didn't change much. So from here to assuming 3 weeks from now, the market is probably going to be somewhere in here. And if it's not, then I'll adjust accordingly. But this is where I think it's going to be a great opportunity for non-directional income-based traders. I'm going to open up my risk a little bit, meaning if I would normally stop out, if I'm down 15% on a $10,000 position, I might say I'll be willing to give it 20% and see if I can hedge the position as best as I can. But I'll give it a little bit extra 5% in risk just because of, I think the edge right now is being in non-directional trades. Now, as we jump right along, I want you guys to let's see what I have down here. So about the FOMC. So yeah, let's actually just jump to the Discord here. And again, regarding being prepared before the market open, it's something that early in this week, one of the trade opportunities was mentioned was Apple. And I tried to mention it before Apple came down to exactly 150. We can see Apple actually ended up taking the Quant Trading App buy zone to the T, and we got the notification alert right away. Now, why did I single out Apple? It's just understanding again the stats behind this, and this is why taking trades based on data or stats and having some sort of conviction behind your trades, it's extremely beneficial to be able to hold trades longer. If you're just scalping, you just need to see the price action and the tape right in front of you. But if you're trying to build out a bigger trade, this right here is Apple. So this is last week, Friday. and Apple closed below 2 sigma, which is something already that's pretty rare. On top of that, I know statistically whenever Apple, or most tickers for that matter, any of the good companies, whenever they close below 2 sigma, if the following week, which was this previous week right here, if we touch the buy zone, majority of the time, say 80% of the time, we're going towards the sell zone, which is why on Monday, it was the only ticker that was mentioned, and I said I would be shocked if Apple closed below 150 at such a strong level. On top of that, trying to provide you guys with some sort of technical context if you wanted to know where 150 is, this candle ended up closing as an inverted hammer. Inverted hammer also for chart enthusiasts or people that read candlestick patterns know inverted hammers is usually an indication of some sort of reversal coming after a downtrend. Now we have 150. Now, for those of us that, or those of you that know that were part of QTA during this time, you know, we swung Apple from here all the way up. It hit 160 within within a week, and then it actually went all the way up to 170 the following week, and this is where it went flat. So there's a saying, I think Brian Shannon, the sort of the guy that's credited with the godfather, we'll say, of the anchored VWAP. I remember he was the first person which I heard say that price has memory. I believe I read it from one of his articles, but price has memory. And I remember trading Apple at 150 and it going up to 160. That means this, I waited, you know, I didn't touch Apple during this whole time, at least in terms of long trades, because I was waiting for it to come back to 150. I'm not the only person on the planet that knew 150 was a great place to be buying Apple, because it's the first time in which it's coming back down to it. There's a lot of people that missed out on Apple adding, I don't remember how much, but it added more than $500 billion in such a short period of time. There's a ton of traders that were upset about missing this move that already had buyer orders or limit orders out. There's a bunch of investors that had orders out, presumably still at this level, saying the next time Apple comes down to here, we need to make sure we buy because of the opportunity that was missed the last time. And this isn't an ordinary company. This is Apple we're talking about. And if you're watching this video 10, 20 years from now and Apple is not, you know, the behemoth that it still is, Apple's currently the largest by market cap company in America and the United States. As we look at this, it coming back down to this level, don't you think there's a ton of other people that are also aware and interested in buying down here? Having opportunities like this, if you're not taking advantage of something like this, these are not trades that you scalp. These are trades that you say, I'm going to build a position around, which is why I had just mentioned to you guys. I said to you guys, first and foremost, it closed below last week. It had its 2 sigma sell-off, which is what we just looked at on the chart right here. As I jump back again, sorry for jumping back and forth. I'm recording this video again more as a webinar, as it's a little bit faster and easier for me to record it. So this is what I'm referring to. If you don't know what I'm referring to as a 2 sigma sell-off, this is it right here. It closed below 2 sigma, very rare. So as I mentioned to you guys, it closed below, it has 2 sigma sell-off last week, and now it's in the buy zone. There's a lot of ways to structure a trade here. I've got my position. I'm starting to build. I'm running 150 calendars, so some at the money calendars, just to let theta pay going, you know, a little bit wider with them. And then I'm entering some 155 call calendars with the shorter back month, because I didn't think it was going to take that long for it to bounce. This is 155, so I'm targeting 155 at least. The calendar has a little bit more room, you know, up to about here. And then there's nothing else really. I didn't have to come in and say anything until a couple days later, because I'm not trying to clutter everyone's feed. I'm not trying to say like, oh, there's a million different no, here's one really high probability trade. It's Apple. So this is the type of positions that's great for any account size. And then just let you guys know, today's essentially payday. Now we're in the sell zone, and it's as simple or as easy as that regarding my type of trading, which I look for, just trying to find 5 solid trades to swing for the week, and then run some spreads, some non-directional spreads on top of that to take advantage of theta, amongst other things. So we have 2 sigma sell-off, buy zone. Quant Trading App sends a notification right here. I'm already stalking Apple, so I can let you guys know before it actually gets to the level, and then you can kind of just sit back and structure the trade. Go 2 weeks out, go with the same week. Structure it as everybody's account size is different. It's not about actually copying or mirroring exactly another person's trade. I'm just interpreting the data and presenting that to you guys for a solid opportunity. Alright guys, this is the following morning. I realized there's something that I missed in the video that I was recording yesterday, so I just wanted to include this. As we were looking at Apple, and I was talking about the swing trade from it right in the buy zone on Monday into the sell zone on Wednesday, how I mentioned statistically this is pretty rare. The reason I know this is because if we were to come to the open, high, low, close table and review the data from the previous year, which is essentially how Quant Trading App works, we can, you guys can take my word or you can go back and look to see if you can find any previous examples. As we come right here, we see the 2 sigma support. We can see that every time, in a sense, it ended up past whatever was happening here. It looked like Apple was in some sort of a pullback, but let's just take a look at how rare it is that it touches 2 sigma support. It's only 9.8% of the time last year out of the 52 weeks. Here's a 2 sigma support, and we can see the following week it was a red week, and then we had a green week right here. Same thing right here. What happened the following week? It was red, and then we had a green week right here. And then we can actually take a look at this. So if this was 2 sigma support, we can see that it actually closed below it. We can press this button right here, and it pulls it up on the table for us. And as we take a look, this is December 17th. Apple closed below 2 sigma. Again, it's pretty rare that it even touches it, but it closing below it, very rare. If we were to jump now to the following week, this was Christmas Eve, so the market was closed. So we can see Apple closed at 171. Let's jump to the 23rd of December. And I believe here it touched the buy zone right here. Monday morning, it touches the buy zone, and look at what it does. It goes up to the sell zone. It actually has a very strong week. This is it closing at 171.14 right here. And then you guys see that. So I'm aware of this type of information, but it kind of carries across the board for a lot of the tickers within Quant Trading App itself. Let's just see how this one looked here. It would have touched 2 sigma support. Now I was trading it during this time, so not every single instance I remember off the top of my head, but let's just see here. So we had a 2 sigma support touch. Now in this case, it didn't close below it, so it's not as crazy. And if we jump to the following week, let's see how it actually ended up performing. Touches the buy zone, and then it actually ended up closing up pretty strong. Now if it had closed below 2 sigma that previous week and then we were in the buy zone, my expected target for it would have been the actual sell zone. But you guys can see that as a couple weeks of examples why when I mention something pertaining to the levels, I'm aware the same thing applies to the SPY, especially the SPY. If the SPY ever touches closes below 2 sigma and touches 2 sigma on a Friday, and then the following week on a Monday we're in the buy zone, it's almost a very easy gift of a trade to be long. It's going to work out 9 out of 10 times, and again, it doesn't mean it's going to work out 100% of the time, which means you don't go all in with your whole account. Now something else I want to also point out this week, which was crazy, that even for myself to see, actually couldn't believe it. Now every Thursday and Friday, this panel right here on the site generates some trade ideas. And this particular week, a few of us were actually crying towards the end of the week because the algo earlier in the week had the Zoom trade idea. This is exactly what the algo said. It was 60% confident that it only gave 1 trade idea for this Thursday. And it's saying it's kind of making an estimation for a 0-day play, so from Thursday into Friday. And if it doesn't happen by Friday, usually we want to keep it on watch for the upcoming Monday, which would be today. But in this particular case, the Zoom 60% confidence it would hit 116. At this point, Zoom was trading at 106. So as we go and look at Zoom on a chart for this past week right here, let's go to Zoom. It was almost insane to see, to be honest, which is why when some of you guys asked me, oh, what do you think about the trade idea for Zoom? I was like, I don't know. I wouldn't necessarily take that just because of it was already at the sell zone. This is it at 106 right here. And then the market looked pretty overextended, but you guys can see what ended up happening. We closed pretty much right at 116.19. We actually hit the target a little bit earlier in the day. So if we come back and take a look, so 116.75, it was actually amazing to see, and I was pretty floored, so I didn't take the trade and I missed it. So I'm sorry guys for anyone that asked me what were my thoughts on this trade idea, and I kind of neglected and ignored it. I took away a really good one from you guys, but that's what's going on over here. Pretty much showing again that the market is moving and controlled by a lot more than just technical analysis and fundamentals. There's a lot of machines and quants, and a lot of the data kind of adds confluence to specific strike prices by OPEX. And this wasn't necessarily a max pain. I believe max pain was somewhere further up here, as it says, where do we have oh, it's actually not on here, but it takes part of that into calculation when it's determining how far something's going to go. I think Max Pain was all the way up here. So continuing right along with what I was talking about before, let's jump back to that. On top of that, Apple, on top of Apple being something that was on the radar, thanks to Brian in here early in the week for reminding us again about, as we scroll up here, I brought it to our attention again, Facebook. So I'm scrolling, I think, yeah, it's this right here. So nope, that was not. This is him talking about the SPY and Qs. Again, it's great to see some of you guys actually have been in here and actually watched the webinars and have a deeper understanding for how to be prepared for the upcoming week. And right here, so Facebook is still showing crazy put call premium, 99% in the money puts, and he's showing the screenshot. Look at this imbalance in which he's spotting. But now this is OPEX. This is $11 million difference in premium going into an OPEX. He highlighted Max Pain 225. Right, he's saying he's doing, what is he doing? This is, again, he's structuring a trade, something in which he's learned. He's going to get a 190 calendar to hedge his position. So in case he's wrong, if Facebook just consolidates around there, he's not going to lose, you know, on that. At least he has it hedged. Then he's getting a really cheap out the money calendar for $17. So it's only going to cost him literally just $17. So this is a 17-cent spread and an insane max profit as he's looking at this. So being able to spot this type of opportunity is important for yourself, so you don't have to, you know, rely on others. What do we have? Here goes our inverted sort of hammer, inverted doji, followed by a hammer. We have the gap up, and then Facebook is off to the races, just running. If we go to the intraday chart, what do we have? A Max Pain all the way up here. These moves were insane this week. As we actually, let's actually just jump to this. I want to just cipher through some of these because this is insane here. Zoom, Max Pain all the way up here, but let's skip Zoom first. So here's the SPY, Max Pain. And again, I'm not sure if there's any other service out there, there's anything that presents Max Pain on your chart as easy as we have it accessible every day. We get the updated Max Pain level and it's plotted on the chart so we can see it visually. And Max Pain is, in a sense, if you don't know, Max Pain in a sense is saying where the option sellers will pocket the most amount of premium. A dedicated video will be created for that. So to keep this one simple, so this video is not over an hour long. Max Pain is pretty much where option sellers will want the market to be, or where they'll want this stock to be at close at OPEX. Again, as I mentioned earlier in the video, monthly OPEX more important than the weekly OPEXs, and then the quarterly OPEX is the most important one because that's where there's the most amount of money. So this is not any ordinary Max Pain. As we continue to cipher through, Q's close pretty much here. This is one of our first times seeing the Max Pain over 2 sigma, which is kind of insane to see. The Russell 2000 started the week, came down to the buy zone, went essentially in the direction of Max Pain, which is something I tell people to look out for. Here's the Dow Jones towards direction of Max Pain. Tesla on Monday down here, Max Pain. Again, these screenshots are taken as the market closed on Friday. The Max Pain changes as the open interest levels change throughout the week. So overnight, sometimes they adjust. I don't know where it was at the start of the week. It might have been all the way up at 860 and then it dropped down to 840 because obviously people are exercising their options. They're closing out their options there, and that's going to affect the Max Pain. As we continue right along, Square, a lot of tech stocks, Snapchat 35 early in the week. Snapchat is down at below 29. These are huge moves. Shopify had such an amazing run this week from 510 all the way up to essentially 700. It hit 728 or something like that after hours. Roku, NVDA, I think you guys pretty much get the gist of being aware of the direction in which these things are going to want to go by monthly expiration. A significant edge in being aware of this, as well as being able to understand how much money is in these. Now, we're going to jump to NVIDIA in a second, but as we wrap up on Facebook, why was Facebook, is because Brian mentioned it, but also its relative strength. Facebook was not selling off on Monday and Tuesday, whereas Apple was all the way down in the Quant Trading App buy zone. So we had this information here, but then as we go to Apple again, and as well as the other tech stocks, and we can see Apple came all the way down to the buy zone. Not only did it gap down, it was pretty weak from the previous week. It gapped down and then it hit the buy zone. The Nasdaq itself, as well as the SPY, we'll jump over to it. We can see on Monday, how was the SPY? The SPY was actually selling off, and it had a bear flag right here. It sold off. It put in what would be referred to as some sort of a bear flag. So it was not looking very healthy, we can say. If we jump over to Facebook was actually holding its gains pretty steady for a bit. It didn't actually put in a lower low. So coming into Tuesday now, I was like, okay, this is probably a good place to get some Facebook calls now that it's proven its strength. My problem is, at least for me, I swung these in naked calls. I didn't structure any type of spreads or any type of calendars. I wish I did, because I would have stayed in it longer. But I was in some 210 calls, and I was also in some 220 calls. But I was in the April monthlies, because the only thing I was pretty sure of coming into this OPEX or before the end of the month was that the VIX was going to come down, because it's mean reverting. And if the VIX was going to come down, then the market was more than likely going to bounce, and it was going to want to balance itself out. So I felt safe, relatively speaking, grabbing naked calls, but I'm not as comfortable swinging naked calls as I am swinging call calendar spreads, or different butterflies or long call butterflies and other more complicated option strategies. But for swinging naked calls, I was essentially flat here on one of my 210 calls, and then I went flat here as the market pulled back, as the SPY was pulling back going into the FOMC announcement on Wednesday. Now, regarding the FOMC announcement, this is why trading with the news and paying attention to too much of the headlines, in a sense, can drive you crazy, because the market's going to do what it's going to want to do. And this is Wednesday here before the market open, just letting you guys know, again, how do you decipher this type of information? Market's all the way up here. You have really no real business, trying to catch these trades here and having high anxiety. If you're anything like me, I also don't like trading feeling uncomfortable, having to hold my breath, and being incredibly stressed out about every position I put on. You want to trade where you have the highest amount of edge, and we have the algorithmic quantifiable levels from Quant Trading App. We have the 2-day anchor VWAP, which at this point you guys have been seeing time and time again. At this point I have about 4 or 5 videos just on the 2-day anchor VWAP. But here's our potential demand zone, and here's our 2-day anchored VWAP. And at this point, I was just saying, let the 2-day anchored VWAP come up to the demand zone. And if the market comes down to this level, if you're not reading the tape, just wait to see if you see some sort of a wick. And that's essentially going to be a good place to be long. So it's extended, or so retracement to at least the 42.53 demand zone would be ideal. This is the 42.53 demand zone. If I were to show you guys the screenshot here, that's what this was. So this is exactly how we ended up playing out. Sorry about that. Let's just make this full screen right here. This was pre-market. Market was struggling at the year-to-date point of control. We pull back. Powell's talking, blah, 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 2 p.m. Eastern time. Market sells right off. Well, look at that. The 2-day anchor VWAP is right in this area. Market comes right down, wicks into this demand zone, and then we take off from there. And then the market just essentially went on an insane rally, following exactly as was mentioned from pre-market on that day, that if that was to happen and the VIX was to go below 28, it didn't matter if there was a 2 sigma level above us. It didn't matter if there was supply zones or any other technical reasons the market was going to rally. Top of that, we had a little bit of confluence with the intraday level from on the SPY for Quant Trading App. And if we were to jump now to, let's see, from that day, essentially the worth of this type of information, or the worth of being able to understand and interpret it and look for these trades, this was this right here. And we saw the wick. So as I always say, again, if you're not reading the tape, just look for it. Let a 15-minute candle close, let a 30-minute candle close. See if you see some sort of strength in the zone. If you're trading on a 5-minute, you don't want to see it sitting in the area for too long. You want to see buyers very eager to get in. This is showing conviction behind buyers in this level. You can see the volume coming in, selling being absorbed, and from that level the market essentially ran. So even if you missed this rally from here into the FOMC, the next best opportunity is right here. So if you can identify before price gets to a certain level where is a great opportunity, from the 42.53 all the way until Friday's close, that was 200 points on the ES, or 4.75%. And from earlier in the week here on Monday into the FOMC itself was already 150 something points. So collectively for the week, around its lows, we're talking about an over 7% rally. So close to 300 points from, the exact low to the exact high, or the exact low would be overnight, but no one's necessarily catching this. But you're talking about 330 something points, 8%, and something the traders from S&B Capital, which is a proprietary fund in New York City, has mentioned. They tell, I think it was something that I read from them a while back, that they mentioned if you can catch about 60% of a move when you're doing your journaling, you're grading how much of the move you caught. If you caught over 60%, that's essentially excellent. So if the total move for something was 200 points and you caught 120 points, you can give yourself an A plus for in terms of how much did you actually capture because you caught over 60%. So a move like this, just catching even from here to here, is essentially over 60% of the whole move for the week. So that's an A plus. And if you're able to catch something like this in this type of market environment, you're going to be able to trade during any type of market environment, because things are crazy right now. Now, moving right along to conclude, I'm going to point out something on NVIDIA here. And another thing you guys will hear me repeating a lot more in the YouTube videos is that if you're new to trading, please stop picking and guessing direction, saying, I think it's going to go up, I think it's going to go down. Don't think about calls and puts. Statistically speaking, you're going to be better off just looking at long setups, which means if you trade options, just look for calls. Even if you see a short coming, that's fine. Let the short happen. Your question to yourself will be, where will the selling stop? Where will I want to be long? It will be easier to become consistent if you're only looking for one direction. Statistically speaking, these companies are looking to go up. If you're trading garbage companies, different story. If you're trading, do you think NVIDIA, which is the largest by market cap semiconductor in America, and this is one of the best companies in America, and based on performance and all the other stuff, fundamentals, all the other stuff that is beyond my area of expertise, and I'm not looking at these companies, at least NVIDIA's earnings reports or anything like that. Do you think in 10 years from now, NVIDIA is going to be trading at 265 based on its current trajectory? It's probably going to be at 1,000 again, and they'll probably do another stock split as they did last year. This company it's on a trajectory to keep going up. Yeah, it might have a couple bad quarters, but there's investors out there that are not looking at it as, oh, they had a bad 2 quarters. This is only 2 quarters here of selling. They're thinking about this is just a good buy opportunity. We're back at the 200-day moving average. NVIDIA is probably going to be worth 500 within the next 2 years. Let's start building a position here. So the long-term trend for something like NVIDIA is in which direction? If we look at, the 10-year chart, we can see the direction in which this thing is going, right? Again, doesn't mean that might change. It might fall out of grace. The company might be struggling, might do something else. But for most of you guys, again, not looking to be investors or anything like that, if you're still just day trading, or you're still scalping, or you're looking to put on little small 2-day, 3-day swings, it's going to be a lot easier for you, even during a bear market. The biggest rallies come in bear markets, guys. The biggest bullish rallies come in bear markets. And if you're ever, concerned, just come back, look at the 2020 COVID crash, a huge rally. Records were being broken constantly. This was a huge rally. This was a huge rally. This was a huge rally. And then we all know what happened here. This was a huge rally. The market has never looked back. Even during this scary time, there was still lots of opportunities to be long. If you know how to spot things mentioned in this video, the divergences in the VIX, where we at 2 sigma levels. Now, we weren't using Quant Trading App back then, but for anybody in Quant Trading App now, we have a little bit of an edge and an advantage in understanding that, as well as we can use other tools to get the divergences in the option premiums. Now, as we look forward here and we jump back to NVIDIA, that means for some of you guys in chat, as I mentioned, don't short or don't look to necessarily buy puts just because we were at 2 sigma resistance. This was by no means an ordinary week. I said, just look for, a place to get long. We could see NVIDIA came right back to the sell zone here, and then it just bounced and took off from here. This right here is straight from the Quant Trading App playbook. The earlier in the week we touched 2 sigma, the higher probability it has. So if this is the middle of the week, if we take the week and we split it directly in half, this is Wednesday here, and this is after Wednesday midday, so noon, Wednesday roughly speaking. this is pretty early in the week. This first touch back down here, it's going to be a high probability bounce trade. And some of you guys in QTA are aware of that because it's in the introductory videos. There's examples of that, but I'll just cipher through some rough examples here. This is showing Tesla, 2 sigma here. It's over 2 sigma early in the week. Here's the first buy on a Tuesday. It opens up at back at the weekly resistance level. It bounces up to 2 sigma here. So this is within 10-15 minutes, bounces, comes back down to level, bounces again. It's not always going to go back up to 2 sigma, but you have a high chance of it going back to at least VWAP. You use your stop loss below the most sensible level. So in this case, this huge wick here comes back down to level, bounces, right? We move it right along. Here's another example right here. Square breaks 2 sigma on resistance. In this particular case, there was earnings pre-market that Monday morning. First touch comes back to the sell zone, bounces. First touch, second touch, bounces, bounces, bounces. So we continue along. AMD all the way here. I remember trading this here. It bounces, goes way past 2 sigma, comes all the way back on that Friday, back to the sell zone, bounces on that Friday. Now you can tell yourself you're going to try and get the short during all of this, saying you're going to time this perfectly, but why try to trade through some of this choppy price action? Now, if you're entering a put calendar spread targeting, 110 while it's up here, that's a different story because you don't need to time it. Time is on your side, Vega's on your side, that your negative delta position's on your side, so you don't need to time it. You can enter in some sort of spread, but for those of you trading naked put options, if you're trading the same week expiration options, this is going to drive you a little bit of crazy, this type of price action, as well as this. Even as it's selling off, look at how crazy this is going versus knowing if it comes down here, I have a high conviction bounce trade coming and my risk is low. Your risk right down here. If it comes down, closes down here, you cut the trade. You lose, 5-10%, depending on what naked option you're in. If you're right, you're getting 50 to 200%. If it's just a Friday in this particular case, this is probably going to be about a 300 to 500% return within an hour. That's how powerful this type of waiting or being patient can pay out. And for those of you that shorted here or tried to take this short, if you go back and you look at this and you say like, oh man, why did I take that short? Even as I mentioned it in chat, and look at the 15-minute time frame, we can see the conviction behind the buyers. We can see this here. Look at this little bit of an inverted hammer here, and we don't even have to necessarily be looking at the charts because that's what the sorry about that as we look at the Discord, because that's if we come to the QTA alerts right here and we were to scroll up, I think what day of the week was that? So this right here is the this is 2:30 p.m. on the 16th. So as we just scroll, this is March 16th, March 17th, March 17th, March 17th, March 16th, and then let's just find that time frame. So 2:35 right here. So here we go, 2:34 p.m. NVDA retraced to the sell zone. We get this in real time. So NVIDIA goes up to 2 sigma, it retraces to the sell zone. The moment it hits here, Discord is notified. Boom, means go take a look at NVIDIA. Same thing right here. Dow Jones, it retraced to the sell zone. Let's take a look. What did the Dow Jones do this week? We go to DIA. Let's see. Dow Jones gapped up, consolidated at 2 sigma. If you're looking to short, this is a short setup here, but why look for this short setup? I've done videos on this over 2 sigma if we have some sort of a pattern and VWAP is lining up with 2 sigma and then we break back below. This is backside weakness, but even so, this is a better setup to go short, but you can do that, or same thing, comes back down to this level right here. The dash level is the this whole zone is the sell zone, but traditional TA says once we break out of a zone, if we come back to it, it's more than likely going to act as the opposite. So if this is resistance, if we break resistance and we come back to it, it's more than likely going to act as support. I've done videos also on that concept, the psychology behind that, and this right here would be just that representation of this. Here goes our zone. We break out of the zone, we come back, you look for a reason to take the trade in the continuation of the direction in which it was coming from. We look back at the chart. That's what's going on here. We break past the zone, we come back to the zone. You can see buyers here. Quant Trading App notifies us. Look for a long entry. Put a stop loss below wherever the wick is. Again, you don't just buy and hold. You still use risk management because that's trading, guys. So hopefully this video helps. Again, it's late Sunday night as I'm recording this. I wish I got this out a little bit sooner. So by the time it's uploaded tomorrow, you guys probably won't be seeing it until midday on Monday. I apologize for that. We'll try to get the video out when I do these on the weekend a little bit sooner, so you guys have a little bit more time to prepare. But hopefully this helps, and I'll catch you guys in the next one. Take care.